get the read on all of this with the Wall Street Journal editorial page assistant editor James Freeman. James, what did you think of the significance of this? I'm going to call it about face. I don't mean to be critical here, but that this is quite a marked departure from comments he made a little more than 6 weeks ago, that we were a long way from being neutral. Now we're there.
Yeah, he's really, I think, saying he's not going to take away the punch bowl because he doesn't think the party is really in full swing. He doesn't see asset bubbles. It is a little odd to figure out how he's saying, on the one hand, as he said for a while, the Fed doesn't really know and has changed its opinion over time on what the natural or neutral rates of inflation, interest rates, employment should be. But he's now asserting we're right near where we ought to be on interest rates. I think he does have a case if he wants to talk about the global economy. Germany's economy shrinking lately. Japan's shrinking lately. China not growing as fast as it used to do. United States still the strong engine, but a little slower lately than in the first part of the year. So he has a case there. But in terms of what has really changed about his notion of where the interest rates, where the Fed funds rate ought to be, I'm not sure we got a lot of information on what changed his thinking.
Yeah, but something did over the last 6 weeks. If you can just stay there, my friend, because I do want to keep you in the mix here with Erin Gibbs, the S&P Equity Chief Investment Officer. We've also got Mike Murphy joining us from Rosecliff Capital, the founder there, and last but not least, Charlie Gasparino. Charlie, I was thinking of you when the president, of course, has been very, very critical of Jerome Powell, saying just recently, no, I don't even have a little bit of confidence in him. I'm not happy with him. Would he be happy with this?
Yeah, I mean, I think Jerome Powell did something really bad. It created a very bad precedent. He allowed the president of the United States to essentially jawbone him into interest rate policy. And
you think he did, or just was responding to the data?
I think he did. And listen, interest rates are really low. We have a fairly decent economy. There's some headwinds. Right. You could see them coming. But if you really are worrying about those headwinds that are coming, you want to raise rates because you want to give the Fed some breathing room just in case we have a legitimate, honest to goodness.
Unless you're looking at something else.
What is he looking at?
Yeah,
he didn't explain it if he is.
Fair enough. Erin, one of the things I always worry about, you love to see the market react the way it's reacting, but then you could stop and say, well, wait a minute. We're up on a Federal Reserve chairman saying the rationale for hiking interest rates to address a strong economy is just not what it was. Right?
Yeah, well, I see a lot of data points that do say we should slow down in 2019, and I agree with a lot of his statements, and certainly.
By the way, the consensus now switched from 4 rate hikes in 2019 to 2 all of a sudden.
Yeah. Well, we were already in the dot plots. That was already a question from the last piece. So this is within the question, and what we were, it's a change, but so have a lot of the data that we've come out in the third quarter, particularly for the global slowdown. And we are a global economy. We're tied to the rest of the world, and that should be a concern. And also, there are concerns about housing. So, and another thing is that we have seen a massive increase in the risk of recession. Not that it's necessarily going to happen in 2019, but we've seen, shop after shop saying there's a higher risk of recession in 2019, and I think they're adjusting to that fact, and that we want to keep the cost of borrowing and capital low.
He was acknowledging that, right? I mean, he's saying, well, look, I mean, I'm still looking at historically low rates. And he's right. They're about half where they historically should be if you look at overnight bank lending rates. But why now? Why this change 6 weeks after making a remark that we were a long way from neutral? Now, I know Terrence's point and Charlie's point, a lot has changed. A jawboning, president, surprisingly, controversial data. And then the GM layoffs that came out of the blue. What's doing it?
Well, what if you just look back, Neil, and the comments 6 weeks ago were a little out of whack, or he didn't maybe he's just talking back those comments a little bit, because by him saying we're nowhere near neutral, it had a major impact on not only the U.S. markets but global markets.
So he regrets that.
So now, I don't know that
his irrational exuberance thing with Greenspan.
Could very well be, but I would argue that the close to 500 point rally we're seeing today is just a relief of the sell-off that we've had. If we were nowhere near neutral 6 weeks ago, we're going to see a lot of rate hikes in the near future. We're no longer a data-dependent Fed.
All right, but the Federal Reserve seems to be saying, not only through the chairman, but the vice chairman, Erin, that we are going to be more data dependent now before we hike rates or do anything like that. That would be deemed constructive, right?
Yeah. And I think from the past 6 weeks, one thing that we have seen is softening in technology orders. Definitely more concerns about Brexit, worries outside the U.S., and the trade war having a really negative impact on global growth. So there have been quite a few negative developments in the past month.
Global growth. I mean, listen, I just wish he was more clear. I mean, listen, maybe there's no reason to raise rates because we're entering a recession. That maybe data is going in that direction. But lay it out, and I think that's one of the problems.
Well, this is as specific as any Fed chair.
No. I think if he was saying, listen, we see inventories building up, we see trade having a negative impact, if he drilled down a little more, it would give me and some others a little confidence that the Fed
but
is
he can also
purely
support what's going on now to say we've hit a sweet spot. Now, I'm not saying that's a good pro or bad.
Listen,
you know?
I never liked this tax cut plan. I always thought it was too
Well,
skewed.
He's more or less saying it's running out of juice.
Yeah, I always thought it was too skewed to corporate taxes and that they were going to do stock buybacks and not invest. So I can see that happening, but tell us that's happening. I hate trade wars, but again, tell us the trade war is impacting.
One thing he did say was that it was going to take 12 months or several months in order for us to see the full impact of the rate hikes. So maybe he's just saying he doesn't want to overshoot it because you read a lot of data out there.
Do we have bubbles
that we always
in this economy?
overshoot?
Listen, one other thing.
Well, we do have some higher than normal valuations. He seems to be saying on the markets, and
I don't think it's
but
that.
they're not wacky. He's saying.
But I don't think it's that the bubble. The bubble is why can Netflix go without making any money and continue to borrow? I mean, that is the issue. When you have companies that could just borrow, the market will accept them.
Well, what do you make of that, James Freeman, that it's always in the eye of the beholder, to Charlie's point, but there are certainly signs of some who can take advantage of this and exploit this and leverage this. So for them, and maybe it's a fine and a lovely bubble, it's not as widespread or pervasive, but what do you make of that?
Well, we tend to only know in hindsight, but I think Charlie's example is not a good one because I think a company, Netflix, I don't think Netflix's ability to borrow to fund its expansion is a measurement of a bubble. It can be reasonably a measurement of investors admiring this disruptive company, admiring its growth and its gains for market share.
But it doesn't make any.
Well, this was the story of Amazon for years and years. That doesn't mean that there's a credit bubble.
James, for every Amazon, there were 10 others that went bankrupt. I'm just telling you that.
So you're saying bubbles are still out there?
Well, if you can borrow willy-nilly,
you don't know it from Netflix.
Willy-nilly, that's a bubble.